Okay, quick review of Chapter 9, Inventory Management. Much of this is covered in the video on the case number 4, the Parts Emporium case. So there's very little review outside of that to do. Just a couple of things I did want to touch on. So first I want to talk about inventory trade-off. All I'm showing here is a few things, arguments to be made for each type of inventory, a large and a small inventory. In a small inventory, much of the arguments for it are focused on cost. In fact, it's about having a low carrying cost. And these are some of the attributes that contribute to a carrying cost or the holding cost. The WACC, that's the weighted average cost of capital. We haven't gotten into any of that in this course. But if you do finance, you will see a lot of this. It's basically how much it costs to borrow money. So in the current environment and current climate, with interest rates being low, it would be expected that the WACC would be fairly low for a company. Another thing that makes up the holding cost is the storage and handling cost. And that's basically you have to rent warehouse space, or you have purchased and built a warehouse. It costs money to store things, and it also costs money to handle those things, to move them around. Carrying a small inventory can reduce that. One of the other interesting ones is taxes, and quite often at the end of the calendar year, which is the end of the tax year, it will be calculated on your inventory at that moment. At that moment in time, you will pay taxes on that. And that's why one of the reasons that there are such big sales at the end of the calendar year, for a lot of businesses that are dealing in high inventories, that is the case. So you reduce your tax costs. Another thing is insurance. The less inventory you carry, the cheaper it's going to be to insure that inventory. And shrinkage. There's a couple of factors that can contribute to shrinkage. One is what they call in the book is pilfering, which is theft. Breakage is also shrinkage. So the whole idea behind a small inventory is to reduce those costs. If you can keep those costs low, why would you want a larger inventory? Or what's the motivation behind a larger inventory? First up is customer service. So you're going to have the product available when the customer wants it. So what you're doing there is reducing or eliminating stockouts, the situation where a customer comes to look for something and you don't have it. So you want to reduce that. You would have to carry more inventory. Another one is ordering costs, and this is the whole quantity discount thing. So you want to minimize ordering costs. And this comes into our economic order quantity and other things. To give a little example of order costs, for instance, I had an employer, and every time a purchase order was processed, it was determined that the entire cost was about $140. So someone would have an account, and they might have an account with Staples to order some stationery. So they might put in an order for stationery for $40, a couple of boxes of pens, miscellaneous goods that the office would need to keep running. And the ordering cost was $140. So that was a total of $180 for that $40 worth of goods. Part of the argument can be made in that situation, they should have ordered much, much more and just stockpiled some office supplies. In reality, what you probably want to do in the context of this course especially is do some process analysis and figure out if you can actually cut that cost down. Another one is setup costs, more manufacturing related, I think, and that is how much does it cost to change your equipment over to make a different product. Very few businesses make a single product. There are variations of a product, things like that. So how much does it cost to switch over your equipment? Another one is utilization. Having a large inventory, you can have high employee and equipment utilization. So if the slowest machine you can buy to make widgets makes 100,000, then maybe you want to look at carrying a large inventory of widgets so your utilization is up. Another one is transportation costs. I'm sure at Christmas time, anyone sending gifts around notices that as you add the goods to a shipment, the cost doesn't go up linearly. So if you were to put 2 envelopes inside one, you're not paying the same cost as 2 separate envelopes would cost to send. So by ordering in larger quantities, or ordering in quantities that are easily shippable, such as container quantities, pallet quantities, you can cut down on transportation costs. And then another reason to carry some extra inventory is payments to suppliers. And the book uses the example, of course, of a product is going to go up in price. So you would order more of that product while the price is low. And a lot of times this is the kind of thing also that happens when a product becomes end of life and there are discounts given because a new product's about to be released. It also applies to international orders in the currency conversions. So right now the Canadian dollar is fairly low, somewhere around 72, 73 cents, I believe. And if you knew that the dollar was going to go lower, it might be worth purchasing some additional product from, say, the US, carrying more inventory so that your payment would actually be reduced. Again, lots of material was covered in the review of Case 4, so I'm not going to touch on too much. I do want to say that the economic order quantity and its associated formulas are important to know. You should be able to kind of pull these things up right out of your head. So I'm going to say that the total annual cost is going to be the holding cost plus the ordering cost. Pretty simple there. The total cost is the sum of all the costs that we're dealing with. The holding cost is going to be the cycle inventory times the holding cost per item. And the cycle inventory is Q over 2. That's the average cycle inventory. Your ordering cost is going to be the demand divided by the Q, which is the lot size, times the setup cost. That is the setup cost for machinery. That is the setup cost for processing a PO. And lastly, for a Q system in particular, the optimal Q, which is the economic order quantity, is the square root of 2 times the demand times the setup cost divided by the holding cost. And that is particular to, as you can see down below, the continuous review system, or the Q system. That's the reorder point system. The reorder point system is based on ordering a constant quantity with a variable time. Every time your inventory hits a certain level, you will reorder an economic quantity from a supplier. The thing that we didn't do is quantity discounts, but in the real world, that is the norm. So you go to Staples and you're ordering 1 box of pens, or you're ordering 1,000 box of pens, they're going to give you a discount on the 1,000. That is on page 362 in supplement C. That's not important for the exam. You won't need to know that on the exam or anything like that because we didn't do supplement C. The reality is that's a much more common way to do a continuous review system. Then the book talks about the periodic review system, which is the periodic reorder system, and usually that's a fixed time frame, and many of the economic order quantity rules stay the same. The time is the same, but the quantity that you order changes. And the whole idea is that you're going to bring your inventory up to a target inventory every time you order. So you'll assess how much inventory you have a target inventory to keep, do the difference, and you're going to order that amount. The periodic reorder system also talks about a continuous inventory system. That kind of fits in with the continuous review system, or the reorder point system, and that many businesses these days, because of computerization of inventories, are on a reorder point system. They don't pick the period and then constantly order on the same period. They order when inventory drops to a certain level, predetermined level, based on demand, sales, a whole lot of things. In fact, ERP systems can completely take care of that to the point where they can actually order from vendors these days. But as I said, it's important to know, though, the holding cost and the ordering cost, and how it adds up to be the total annual cost in a continuous review system.